The volatile crypto market keeps investors, observers, and regulators on edge. CNBC Crypto World features high-profile interviews, explainers, and unique stories from this fast-moving sector. A disgraced cryptocurrency exchange founder has published a lengthy blog post that appears to lay out his defense against fraud charges. Meanwhile, the U.S. Senate passed a national defense bill that includes a provision targeting crypto mixers and anonymity-enhancing coins. FTX files for bankruptcy. The crypto market's dark winter deepened this week as FTX, one of the world's top exchanges, filed for bankruptcy. The news sent prices lower across the board and prompted worries about the stability of the sector as traditional financial firms invest more capital and regulators seek to bring more structure to an industry with no clear rules. FTX's bankruptcy filing revealed it owed billions to its customers, many of whom haven't received their assets. It also said it had more than 130 affiliated companies around the world. Founder Sam Bankman-Fried, who has been accused of embezzlement from his cryptocurrency hedge fund Alameda Research, stepped down as CEO of FTX and its holding company on Thursday. Bankman-Fried's downfall has raised questions about the ties between his various companies and the potential conflicts of interest that might arise in dealing with some investors. He was a prominent Democratic donor in the U.S. elections and ran a massive advertising campaign, using celebrities like Tom Brady and Gisele Bündchen to promote his investments. Analysts say FTX's bankruptcy could lead to more failures as the sector faces structural problems such as low transparency and bad risk management. Several other exchanges have already collapsed this year, and many others are struggling as they try to raise funds from institutional investors. Despite the turmoil, some analysts remain optimistic. "I don't think this is the beginning of a crypto regulator nightmare," said Wedbush Securities analyst Dan Ives. He said the market will rebound after this week's events and that more regulatory clarity could give investors confidence to continue investing in crypto. This week, the United States Senate passed a national defense bill worth $886 billion that includes a provision targeting crypto mixers, anonymity-enhancing coins, and institutions that engage in crypto trading. The measure is expected to go to President Trump's desk for his signature. It is the second time this year that lawmakers have advanced a crypto-related amendment. In March, the amendment was voted down in committee but passed by the full House of Representatives. The bill would require federal agencies to create rules governing the use of crypto. Binance buys FTX. Crypto traders have seen a lot, from hacks and mind-boggling swindles to sudden success stories. But not even they've seen this. Binance, the world's largest crypto exchange by volume, is buying its closest rival. The news sent shockwaves through the industry and sent digital assets tumbling. The deal marks a tectonic shift in power for the loosely regulated industry and cements Binance founder Changpeng Zhao as one of its most powerful players shaping the future of crypto. The announcement came as markets, already reeling from a brutal year of losses, were on the verge of a new panic. Earlier this week, reports surfaced that FTX faced a liquidity crisis that could have spread to the rest of the industry. The company halted withdrawals after a CoinDesk story pointed to evidence that its financial foundations were shaky. That set off a bank-run-style rush for customers' funds and led to concerns that the collapse of FTX could lead to an implosion of the entire sector. Investors rushed to pull their money out of the exchange and other crypto firms with ties to the firm, sending digital assets plunging. Binance's move to buy FTX sent the FTX token tumbling on Tuesday, though it recovered somewhat after the announcement. The company didn't disclose the terms of the deal. It also didn't say whether the purchase would include the U.S. operation of FTX, which has faced regulatory scrutiny from federal regulators. The deal reportedly grew out of a months-long public spat between the CEOs of the two companies. The feud intensified this week after a report by CoinDesk pointed to evidence that Alameda Research, a trading firm founded by Sam Bankman-Fried and which has close ties to FTX, was on shaky ground. On Sunday, Bankman-Fried tweeted that his firm would liquidate its holdings of FTX's FTT token in response to unspecified recent revelations. Binance said it planned to conduct due diligence on the purchase before finalizing it. The news shook the industry and was a wake-up call for investors who've been buying into the promise of digital assets as alternatives to traditional investments. FTX founder pleads not guilty to criminal charges. Sam Bankman-Fried, the founder of the collapsed crypto exchange FTX, is facing a litany of criminal charges. He appeared in court Thursday to be arraigned on an updated indictment with 5 new counts, and he pleaded not guilty to all of them. The 31-year-old, who was formerly one of the industry's most celebrated success stories before his fall from grace in late 2018, is accused of misappropriating billions of dollars in customer deposits. He is accused of using FTX's funds to fund his other firm, Alameda Research, and make speculative high-risk investments. He also allegedly used the proceeds to buy property and make political donations. Two of his closest business partners have already pled guilty to some charges and are cooperating with investigators. If convicted, Bankman-Fried could face more than 100 years in prison. He's out on $250 million bond and living under house arrest at his parents' home in Palo Alto, California, while he awaits trial. Amid the turmoil over FTX's bankruptcy, Bitcoin's price plunged below $4,000 Wednesday. But it's rebounded to a more stable $4,585 as the market digests the news. Meanwhile, Ripple's XRP has been gaining ground after the SEC dropped its case against the popular cryptocurrency. The SEC's decision to drop the case against Ripple is a big win for the decentralized currency, but it's only a temporary reprieve. The agency is still pursuing 7 other charges, and the company will go on trial next October. In other crypto developments, the U.S. Senate passed a bill on Wednesday that will boost government monitoring of crypto markets. The 2024 National Defense Authorization Act includes a provision that requires the Treasury Department to study ways to crack down on anonymity-enhancing coins and crypto mixers. As for blockchain censorship, some of it is real and growing, but most of it is false. Here are the most common myths and misconceptions surrounding this controversial topic. FTX's bankruptcy is a Lehman moment. In many ways, FTX's collapse is a Lehman moment for the crypto industry. It's the biggest loss to date by a big player in the space, and it's putting pressure on everyone else to clean up their act. It also threatens to push institutions away from crypto just as they're starting to warm up to it, and it will embolden regulators to tighten the screws on firms that survived the implosion. The bankruptcy filing has already prompted some of the largest crypto investors to write down their investments. For instance, one major venture capital firm that invested in FTX says it's written down its investment to zero and that it considers the entire company worthless. That's a sign of the tumult that lies ahead for the crypto market. Until this week, FTX was widely considered one of crypto's blue-chip companies. It was a well-capitalized firm that spent much of this year bailing out other firms. It was also viewed as a stable business that didn't engage in risky speculative trading or gamble with its customers' money. But now FTX's bankruptcy filing has thrown a huge wrench in that narrative. It's left a lot of creditors in the lurch and has created doubts about the security of other crypto services. In fact, it's helped prompt some of the biggest players in the industry to crack down on hacking. One big question now is whether the bankruptcy will trigger a wave of margin calls and deleveraging that will see other smaller crypto firms fail. And that's a very real concern because it could push the industry into a deep bear market. The bankruptcy filing has also highlighted some of the conflicts of interest in the crypto world. For example, FTX donated millions of dollars to political groups and PR firms that often work with the crypto industry. It also paid lobbyists to try to get laws passed that would benefit FTX and hurt competitors. The filing also included emails showing that a PR firm working for FTX was pushing activists and political influencers to speak out in favor of the firm's legislative agenda.